So I'm very pleased to welcome my fellow panelists. So please, Lewan from Partech, please. And Daisy from TLcom, please welcome. And Dan from Adenia and George for Africinvest. Happy to welcome you on stage. And I'm happy to share the stage with partners. You're all partners of Bpifrance. We are very happy and proud of that. First of all, I just will let you to introduce yourself. So, George, please.
Thanks, Isabelle. So I'm George Odo from Africinvest. I'm one of the senior partners in the firm. Those of you who are here in the morning must have heard my founding partners talk about the firm. Been around for 30 years, done over 200 transactions in the continent. So yeah, we're one of the older guys. We do private equity, do venture capital, do private credit. We have permanent capital vehicles, we have traditional funds. And yeah, I'm responsible for running operations in Eastern and Southern Africa, out of Nairobi. Pleasure to be here.
Thank you, George. Daisy.
Thank you. I'm Daisy Liech. I'm a director at TLcom Capital. And TLcom Capital is a venture capital fund that's been there for over 25 years, currently based in Nairobi, Kenya, and Nigeria, and London. We have 22 companies that we've invested in, and we invest a minimum of $1 million to $15 million in tech businesses. I'll speak more to the company as we go along.
Thank you, Daisy. Lewan.
Hi, everyone. I'm Lewan KEFELA. I'm a principal at Partech Africa. Partech is a global VC fund with over $3 billion in assets under management. For Africa, we manage about $450 million across 2 funds and have invested in about 20 companies across 9 countries on the continent. Great to be here.
And Dan, finally.
Yeah, good afternoon, everyone. Dan APUNGU, for those who don't know me, principal at Adenia. Adenia we have 7 offices in the continent. We're a Pan-African-based private equity investment entity. We make controlled investments. That has been our mantra since we started the fund. We're also quite an old fund, been around for 20 years. Thank you so much for having us here.
Thank you very much. So now I would like to start with you with where it all started and when we are at today. So I would like you to talk about the initial opportunities you had in Kenya, in East Africa, and what is the situation now. So perhaps George could give us some insights about the situation.
Yeah. Thanks, Isabelle. So going back into time, almost 1.5 decades ago, there were not very many private equity players in those days. We probably were few. There was Orios then, there was Actis, Africinvest came into the market. So not very many players in this part of the world. We opened an office here because we've been scouting around since 2008, and 2009 we set up an operation. And our first investments, we invested in a bank, invested in an insurance company, we invested in a school, invested in the health sector, invested in Kenya, invested in Uganda, did a lot of regional businesses. And because the market was very nascent, we literally had to be market makers. So we had to find deals, we had to explain to entrepreneurs what private equity was all about, help them get advisors, structure the deals. Today it's a lot more sophisticated. We see a lot more players, there are more transaction advisors, more intermediated transactions. So the market has certainly matured. If I think back to those days, when we started the East Africa Venture Capital and Private Equity Association, we probably were, 6, 7 founding members. Today the association has close to 90 members. So the association has grown, the industry has grown. But I think if I may, Isabelle, let me just touch on 1 or 2 points that is different today than what it was at that time. And it's really the macros. Macros are obviously something that sometimes is unpredictable. Storms come and you deal with them. But I think what's been very unusual in the last few years, 5 years for sure, is that there's been storm after storm, and my colleagues will probably agree with this. Everybody talks about COVID, everybody talks about supply chain challenges, out of the wars, but I think there's been something very peculiar in the last few years. One is, if you look at the pressure that's been applied to local currencies, because the US currency has strengthened against local currencies aggressively. So a lot of local currencies have depreciated. That then led to a very interesting situation, because a lot of governments have overborrowed, and they do it out of, for good reason. They want to develop their countries, put in infrastructure, but they over-leverage. And when your local currency weakens against foreign currency, you suddenly find, and it happened to Kenya, that a debt to GDP ratio of 55%, suddenly today they're 68%. Your currency weakens against hard currency, your debt to equity ratio changes, debt to GDP ratio. So first problem, currency situation. And then it wasn't just weakening of currencies, but there's also a shortage of currencies. And this is something that has a direct impact on how you source for opportunities and how you think about opportunities. The next problem I'd just like to highlight, a macro sort of issue, is how did governments respond? They started borrowing locally. You borrow locally, you drive interest rates up. A lot of the businesses, a lot of entrepreneurs suddenly find that they're having to borrow against government. Government drives the cost of borrowing up. Banks would rather lend to government. That was another situation that happened. So the cost of the debt market had an impact. Bond markets, there was an inverse yield curve. So short-term paper was actually more expensive than long-term paper. All of this impacted on investments, whether you're investing in bonds, equity, there's an impact directly. And this then led to a situation where, sort of an unintended consequence, where you find that there's all these countries. Africa's known to have one of the youngest population. Kenya itself has a youthful population. Numbers say Gen Zs and millennials are probably 50-55%. If you expand it to the actual definition of youth, maybe it could be close to 65-68% of the population are young. If you look at unemployment, 12% is probably the number for youth unemployment, and 5.6, 5.7 is the number for total employment in Kenya, according to World Bank. So you think about all of these macros and the impact they have on the youth unemployment, then it explains what happened to Kenya 6 months ago when the young population revolted. And it's not a Kenya-specific problem. You can look at it at Sahel, blame it on terrorism, blame it on Al-Shabaab, but it's the same issues. It's weakening currencies, it's debt pressure, and it's youth unemployment. So all of this, Isabelle, has forced us to think differently when looking for opportunities compared to what we did before.
Thank you, George. Dan, do you want to complete and tell us about now you are looking for opportunities in the market?
Yeah, no, I think George just touched on transition points. I think certainly when I look at the era before COVID, certainly I think Kenya and East Africa was certainly more predictable. And I think that when you kind of look at now for the factors or the reasons that George gave is certainly more unpredictable. And we're here to inspire and connect, so I won't touch on what the governments can do. I will touch probably on what we've done as a fund. I think as Adenia, our strategy has been to take controlling stakes in entities. And I think that allows us to be more flexible in a more challenging macroeconomic environment. Whether it comes from setting management right, whether it comes from setting direction of entities in a certain direction, I think that control allows us to be more flexible in an uncertain environment. So I think that certainly helps as a response, and that's what's led to have investment in some of our portfolio companies. I think the second tier is naturally just diversifying, being able to have a fund that is operational in 7 different markets, east, south, west. It really diversifies the portfolio as a whole. So I think when you add those two together and you look at your portfolio, that's a way that I think private equity funds look at diversification, and that leads to how we source some of our investments.
Thank you. Lewan, so can you give us your opinion about the market when in venture, but also to compare with the 2 other markets that Partech knows very well. It's Nigeria and Egypt.
Yeah, happy to provide some more context on that. So we actually haven't made a direct investment in Kenya, and it's an interesting point since I'm based in Kenya. It's kind of a question I get quite a lot. I think it's for a couple of reasons. When we opened our office in 2019 and started to think about where technology is going to go in Africa, there was kind of a rush of interest into Kenya because of the mobile money penetration. There's this logic in the thinking that if everybody's comfortable with technology, they're comfortable in transacting on their phones, then they're more adaptable to new waves of technology, and you could be dealing with a population that's more ready for technological innovation. What an interesting challenge it's kind of presented is when you look at emerging markets globally, fintech tends to be the biggest opportunity, and it tends to take up a significant portion of returns in more developed emerging markets. So similarly in Africa, when we're thinking about where does venture go, fintech tends to be the first and most important layer. Because of the strong mobile money penetration, that layer was effectively sort of taken up. And there was a lot of strength that that M-Pesa kind of brought into the ecosystem, but there's also some setback that it brought as well. We're starting to see people building on top to this 2.0 layer of fintech, but it's moved quite slow, to be frank. And what we're actually seeing Kenya kind of emerge separate for the other three big markets in Africa, which are South Africa, Nigeria, and Egypt when it comes to technology, is that the innovation that's coming to Kenya and the funding that's going to Kenya is actually moving outside of fintech, and it's moving into things like clean tech. We just talked about the importance of renewable energy in this market and how there are unique qualities that sort of make this market particularly ready for renewable energy and clean tech. And as a result, we're kind of seeing the money kind of flood into those kinds of innovations because we see Kenya as a unique place that can foster that kind of development relative to markets like Nigeria and Egypt. And kind of the interesting thing there is obviously Nigeria and Egypt don't have mobile money penetration. They don't have that fintech layer figured out. So there tends to be a lot more money flowing into these markets to capture that first opportunity. But I think as we think ahead of like how these markets are going to continuously evolve, there's a lot of potential still in this market. It's just not necessarily coming from fintech today. And I think Daisy might have a different opinion, so I'm happy to have some mic.
Please, Daisy.
No, so yeah, Lewan is based in Nairobi, and we asked her which deals they've done in. But yes, so TLcom actually set up in Kenya in 2013, and I like what George said because I was in private equity during that period, and so the market did shrink for PE, and you could see a lot of deals. And I remember we were raising a fund. And the question we were getting from all the DFIs and commercial and family offices was, then what are you going to invest in? And so I'd say first, venture capital in itself is a huge catalyst for any economy. If you look at how the North America, Europe, and their history in VC, it's what really catalyzed what they have today. The market is mature, the capital markets work, so there's a path to exit. And you look at the period between 2013 say to 2016, there were only around 60 venture-backed deals. And then fast forward to 2020, there's a spike of around 300 plus venture-backed deals. And to her point, yes, M-Pesa was a huge catalyst actually. That's for us as TLcom, allowed us to invest in a couple of Kenya assets, including one of the most famous then being Twiga Foods. So what you saw is there was a lot of B2B and B2C catalysm that came from M-Pesa because it was a free education for most venture capital companies to their customers on how to transact, how to pay. And I also agree with Luam that because of how fast M-Pesa disrupted the market, there was not a lot of fintech we saw as TLcom in the space. So that then what we did different, or what we've seen differently, is we also then expanded to the other regions. So if you look at our portfolio today, we have fintech that leads the portfolio, and a lot of it is based in Nigeria. I mean, Kenya is 20% the size of Nigeria, just to give context. Fintech as well in Kenya is a lot of, there's not so much fast mile you can do, while in Nigeria, the market is a bit fragmented when it comes to financial services. Then fast forward again to, say, 2023, you see venture-backed deals have spiked to over 800. And now there are new structures, so it's not only equity, there's now debt, there's venture debt. And so that continues to catalyze how we look at the market. And today, we've actually been a bit more comfortable to invest in, say, fintech, which is like Shara in Kenya, and also Pula, which actually expanded from a Kenyan business and now is offering insurance services across the globe. So I think to sum it up, it's to say the impact that we've seen in the market, the capital market was not so active, and what George you mentioned really gave the venture space an opportunity to, grow and catalyze this market. I'll be honest to say that the last 2 years has been a bit painful, and not only for venture capital, but also for PE and everyone else who was an operator. So I also worked for an operating company. And that has just made us more aware in terms of how we deploy capital and who we give it to and some of the metrics that we look for, as opposed to just revenue and growth and scale as a path to exit. It's now more how efficient are you running the business? Because then how efficient we are as a fund is how we are measured.
And just to continue and to talk about your the champions you support in the region and specifically in Kenya, can you give us some details about the companies you have invested in?
So in Kenya, we've invested in a couple. So in fintech, we have Shara. Shara is a microfinance transitioning to a new bank. They actually bought a bank last year. It's one of our best performing portfolio companies. Pula is an insurance company. So they provide insurance to farmers across Kenya. And they've actually de-risked their model in that they've partnered with insurance firms, global insurance firms, and then they've partnered with the government. So then they approach farmers, they do pilots and understand the potential yield and insure based on that geographical data set. So Pula has today grown from Kenya, it's now in the rest of Africa and actually in Asia. So I'd say those are best performing. In terms of what we've seen, we were one of the initial investors in Twiga, for instance. So it was our almost unicorn company. And through it, we've learned a lot in terms of how businesses can grow very well. And I think we'll talk about impact and why it's still important to have the return fundamental as a driver of a business. So I'd say those are the major ones in our first fund. So our first fund was $71 million. And we've closed our second fund this year at 150, and it's allowed us to continue these investments.
Great. Lewan, can you complete? I know you have not invested in Kenya yet, but you have also champions in your portfolio.
Yeah, super happy to provide some context. I think for us, to Dan's point earlier, I think diversification is obviously important. Our portfolio to date is largely more focused on Nigeria and Egypt. But when we even think about, like, for instance, what we were talking about with M-Pesa, we have a similar company that we invested in Francophone Africa called Wave that sort of has created or has played that very catalytic role in moving the financial ecosystems of those kinds of markets forward. So I think, when we think about what are these long-term catalytic innovations that can happen in these markets, it's taught us that it can really make a meaningful difference for the rest of the ecosystem and even for the perception of regions, because we haven't invested in Kenya, that's true. But Francophone Africa, for instance, was a market that was completely overlooked. And Wave sort of built that success story that really started to put that market on the map and started to highlight the potential of that market going forward. And we've seen a spike in funding happen for that market, where in 2023, Francophone Africa was overrepresented in the amount of funding that was raised across Africa globally. So it's kind of showing that having these level of champions actually really does create those positive tailwinds of more and more funding coming into an ecosystem and more education, more curiosity, and more focus moving into those ecosystems. So that's been really, really fascinating to see. And I think in Kenya, we're hoping and expecting to see a few of those emerge over the coming years. And once we do, I think we'll benefit from those same positive tailwinds there.
Thank you. So now I would like to speak about, of course, about PE. So I know you have champions, but I would like to focus more about your champions with a link with France. Dan.
Okay. Well, before I go into link with France, yes, we do have champions, and I think the obvious champion that Adenia has here in Kenya is Quick Mart, which is the second largest retailer. So for those who don't know Quick Mart or here for the weekend, please visit and check it out. Yes, the link to France and is quite prevalent in one of our other investments, Redlands Roses. It's a leading exporter, it's growing exporter of premium roses, and I think our CEO is somewhere around here. I think the firm, its foundation and how it was founded was French founded by Isabelle Spindler, but I think that carried on to our activities naturally. Specifically, I think recently we've had expansion of the farm, which expanded its production capacity at over 60%. And certainly, from the back end supplier network, whether through the greenhouses, I think that was quite a big, impetus that we received from Rochelle Group, who helped us with the greenhouses. So certainly, there's a big French link there with that asset.
Thank you, George.
Yeah, I'll take from there, and maybe just to add, the very dire situation that I described earlier. We've had to pivot, and part of the pivot has been what Dan mentioned. It's setting up regional businesses, and even as we think about opportunities, we must think about opportunities that target the youth for employment. And it's got to be fintech, it's got to be clean tech, it's got to be, so tech is a big thing. But then the traditional players like FI, what James Mwangi was describing this morning, those are growth sectors, and those we look at. But something else we do apart from looking for good companies, and I will not talk about which are our champions because I don't want to look like we have any favorites. But apart from looking for good companies, we've tried to be thoughtful about our strategies. We've come up with new strategies, and that's kept us going. When we started off, we're purely a private equity shop. Did traditional private equity, the traditional structures, 10 plus 1 plus 1. Then we went and started doing different things, creating permanent capital vehicles, going into venture capital, going into health. Two of my colleagues who run our health business are here, Faisal and Jordan, and it's a private credit fund. It's actually a hybrid fund. It's got a catalytic component, it's got a commercial component. So one of the things we've been doing is trying to be innovative about our structures and how we deploy capital. And it's helped us to attract different types of investors, commercial and public. So one of the most innovative products we have, Isabelle, and I'm not saying this because I'm at a Bpifrance event, is actually the French Africa Fund and the FFA. We've got FFA1, we've got FFA2, and next year, God willing, we'll launch FFA3. This is a very interesting innovating that was actually started, we're reminiscing with Nicolas 8 years ago. Nicolas came to Kenya. Aziz, myself, yourself, Ziad, a few of us went out. We saw some companies in Kenya, and we thought about why don't we develop a French Africa Fund to encourage French businesses to come to Africa, to come to Kenya, come to Nigeria, come to Egypt. And that fund started. We're going to do our third generation of funds. And it's actually our top 2 performing funds in our strategies. We're talking about strong double-digit returns, and we have a lot of local pension funds who started that journey with us. Aziz mentioned Central Bank of Kenya Pension Fund. They've invested 3-4 times. Others have also done the same. That fund has delivered returns and they got a lot of impact as well. So what's innovative about that, Isabelle, is you're investing in European French companies with French private equity. They come and bring companies and investments in Africa. So you benefit from the mature, sophisticated market in France and the high growth in Africa. So you get the best of both worlds. And we've seen companies like PX, strong pharmaceutical company in France, coming to invest in this region. So doing acquisitions here, growing the markets here. So the relationships are sometimes supplier, sometimes are equity relationships, etc. But it's been a very, very successful strategy. And that, I think, is how we need to continue operating. So it's, yes, about identifying companies, but also about being innovative with the structures. So who knows, maybe the next thing we'll be talking about structures for secondaries, you know, because there are lots of products we don't have in Africa that are available in European and more sophisticated markets.
Thank you. And I think it's a good link to the words of conclusion we decided to pronounce, to talk about the link between financial performance and impact. I don't know who of you wants to say some words. From the MOI of Africinvest.
so maybe I can just mention something, and I'll let my colleagues also say something. One of the things we've been doing as Africinvest for the longest time, because we're one of the more experienced players in the market, we then got good at what we were doing. And very often we're always performing at the top quartile. But in the last few years, especially the last vintage of our funds, we got a big slap on the face because of all these macros and everything. Our returns were depressed. And we found ourselves competing for capital when we go fundraising with very sophisticated players who are delivering stronger returns than what you get in Africa. And that was the truth. And we quickly realized we can't compete with Latin America, we can't compete with Southeast Asia, we can't compete with the US, we can't compete with Europe. The returns there were better from a risk-adjusted perspective. So we started to ask ourselves, why would an investor come to Africa? And one of the big reasons is impact. It's not just commercial return, it's impact. And we've been over the years developing a tool together with Harvard University and a US company called Bridgespan. It's called multiple of impact. So when all of us go to our ICs, we pitch and say, this is going to be the multiple of invested capital. This is going to be the IRR. And then we get very fluffy about the impact. You know, it's almost, nothing tangible. So we've sort of broken it up. We've brought a lot of these, if you like, different impact measurements together into one tool. So you talk about a multiple of impact. So you can talk about what's a multiple of invested capital, you can talk about what's a multiple of impact. And it captures everything from job creation, it captures everything from gender and everything. And then you can actually convert it to currency. So you start to monetize it. It's something we released or launched or unveiled during the African Development Bank annual meetings middle of this year. And it's something we're encouraging and showing to a lot of our peers and DFIs, encourage them to use it. There's going to be unveiled again in Casablanca next month by my colleague Brahim and our CIO Skanda and my colleague Aisha, who's in charge of our impact business. But that's something that's exciting us because it means that when you're having a conversation about Africa, it isn't just about a commercial return. You can show how many jobs you create. For every dollar you spend, how much impact are you going to generate?
Yes, very interesting. Daisy, your comment.
I agree actually in that impact comes, in my view, impact, or in our view, impact is as a consequence of return. If you're able to grow a business 10x, your ability to employ maybe a 20x employee base is there. So how we look at impact is not more from how we raise the funds, it's because we are investing in impact first, but actually profitability first. Because I think there's a direct link to profitability, and globally, everyone is measured on IRR, on how much money you make. As a fund, you're definitely looking at your portfolio review and seeing, what's the multiple on your fund before you say, how many people have I employed? We've seen businesses that shut down in the wave of last year that, had great impact stories, had multiple kitchens, employing over 1,000 people. But that's not what drove the performance of that business. So I take a contrary view in that I find, and we believe, there's a lot of impact money that is always directed to Africa. And to some extent, we also need to get Africa out of that poster child for impact and measure it in the same global metric of return. Because that's where you say, okay, fine, if you build a business with great fundamentals, it's likely to be listed. We have one business called Andela, which started in Africa, and it's our unicorn. It's now about to be listed, hopefully, on NASDAQ. The impact that business has had, the impact from its growth is extremely massive. And so I'd say it's more a consequence of return than the other.
But just to be clear, we're not contradicting each other, Daisy. What we are saying is we take it to the next level. Impact alone without profitability is not sustainable. So that's not what we're talking about. We're talking about profitable businesses that cannot compete with the profit return of more developed markets. But you've then got to ask, why is it not as competitive? We don't have the same infrastructure. We have a less, if you like, skilled, youthful population. So the impact in Africa, the bang for your buck for every dollar you put in Africa, from an impact perspective is higher. From a commercial perspective is lower. So we're measuring both. It's not either or. So we're taking it to the next level.
So Lewan, I see.
Yeah, I wanted to add maybe a small level of nuance because I think that there's also a difference in how we're thinking about it in venture capital versus private equity. In private equity, your risk profile is effectively lower. The expectation of returns, or at least how you're thinking about returns. So in more developed markets, because I used to work in private equity too, in more developed markets where you can deploy a ton of capital and put it to work, and then have a more easy or relatively easier system for exits, it sort of makes, that's what private equity is built on. When you look at venture capital globally, venture capital as an asset class, it's very hard to perform. And you see like a lot of funds and a lot of new funds not getting to the second fund because it's very, very difficult to perform. So I think for us from venture capital world, and given that we are also targeting much, much higher growth businesses that can, God willing, absorb some of the macroeconomic shocks and devaluation and all of that, I think for us there's at least some potential to be able to start to push towards those marks, rather than for private equity firms that are investing in more mature businesses that are growing a bit slower, that have to absorb those shocks on a day-by-day basis. So I think that's a little bit the nuance there as well.
There is something I want to say. Our tool cuts across private equity, private credit, venture capital, across different strategies. We've actually used it with our VC deals, and it's really mind-boggling. It's eye-opening.
We should have begun by this subject, but perhaps the last word for Dan, just to conclude.
No, I think a lot has been said. I think when I look at impact investing, the one metric that I think that we have tried to do at maybe QuickMart has been not only to look at the direct impact, but the indirect impact. So I think that's the second leg that I would challenge, I think all GPs to kind of look through that lens. In our instance, looking at the farmers behind some of the the suppliers who come into a supermarket chain, I think that's another angle that I like to throw there, which I'm hoping maybe George doesn't have a response to.
No, I'll share the tool. It captures indirect impact, and this is where we admitted this is not our area of expertise. That's why we brought in the Harvard Business Schools of this world and Bridgespan. And by the way, this isn't an invention of Africinvest. It was being used by people like TPG in other markets, Latin America, North America. So we just contextualize it for Africa. But you're absolutely right. You can't just look at direct, you look at indirect. Let me tell you what we'll do, you guys. I'll share the tool.
Please share the tool.
But if you want, we can continue the discussion at lunch if you want. Thank you very much.